Traders Corner is proudly brought to you by IG, the specialists in CFD trading.
Welcome back. You're watching Traders Corner, and as always, I'm joined by Garth McKenzie, who is the founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, I know that you want to start off by looking at the various sectors of the JSE at the moment before we discuss the trade that you have put on for the portfolio at the moment. So perhaps we start off with the resources sector, which has been kind of the dog of the JSE this year, and it's been that and it remains that, doesn't it?
Well, it does at the moment, yes, but I want to look at the three major sectors, the resources, industrials and financials, and then we'll look at the top 40 after that to try and ascertain where we are in this market. Because I must say, and I think anyone that watches this show and trades the market will agree, the last 3 months have been very choppy, or rather directionless on the market at large. So it's quite interesting to actually break it down and look at where we are in each of the sectors now, and then to build a picture for the rest of the year to see what the possible outcomes are for each of the sectors, and then to look at it in the context of a top 40 and an option structure that we'll talk about at the end of the show.
Yeah.
So let's look first of all at the resources sector, which you can see on the screen now. Now this chart goes back to late 2012, and what you can see is that since July last year, over the 1 year period really, we have actually done okay on this index. But over the last couple of months, certainly since the middle of July, the resources index has underperformed the JSE quite significantly. And it's actually down about 11% from its recent high towards where it is now. But it's getting to a very interesting level where you can see that there's that significant lateral support now. These prior highs over here were previously resistance, but you can see that pullbacks towards this area have found support in the past, and I expect that now at 54,200 we could quite likely see the resources index once again finding support at this sort of area. So whilst this has been a laggard in terms of sectors in the market at the moment, it definitely is one that's starting to pick up my interest if we were to see some buying and some support emerging at this 54,200 area.
I mean, that also, it looks almost like an incomplete head and shoulders pattern though, which suggests that maybe you're going to build up into a right shoulder and then it could all tumble south from that point.
Look, it's possible, but that's very speculative. My feeling on head and shoulders patterns is that they work as often as they don't work. So, and to now say, well, we might see the formation of a right shoulder, it's way too early to say. So I think first and foremost, we've got to respect the fact that there is support coming up right now at about 54,000. Let's see what happens at that area, and if we reverse off that level, then I think there's a case to be made for buying the resources shares.
What about the industrial sector? And that has been the strongest one of the JSE, thanks to essentially a couple of stocks, and we saw, for example, yesterday SAB Miller hoisting the JSE higher on the back of that extraordinary move. If we hadn't had that, we would have ended the day in negative territory. So it's been just a couple of shares really that have taken us up.
Very much so, but they're also very much the non-resource rand hedge stocks that have been taking us up. So it's been SAB Miller, it's been MTN, it's been Naspers, although not so much this week. There's a handful of other really good quality non-resource rand hedge stocks. And this area of the market, the industrial sector, really by and large remains the strongest area of our market. It is currently making new all-time highs, and we like sectors, we like stocks that are making new all-time highs but are consolidating. So if you look at that chart that's on the screen now, I mean, that's a fairly recent chart. It only goes back to May. But you can see the sideways action that we've had since June. But we have noticed the industrial index now breaking out through this area of overhead resistance. And you could almost argue that this is actually a sort of an inverted head and shoulders pattern that we've broken through the neckline of now. And I like the fact that we've consolidated above this, what was previously resistance, it's now support. We're consolidating above that area. And it actually does to me look like the path of least resistance from here is up, and the likelihood is that we're going to probably see continued gains from this sector looking out into the end of the year. And based on just the short-term technicals there, that inverted head and shoulders target could probably justify a target of 62,500 on the industrial index, which is a little bit higher than where we are now.
Yeah. What about the financials, Garth?
Financials also doing well, also been a sector of our market that's performed very well over the last year or so. If we have a look, there's an uptrend over there which which comes into play kind of where we are at the moment. But what's also interesting is that through July and August, we had all this overhead resistance here, and the market really, or the index, is actually pulling back towards that support level, which comes in at about 14,700. So once again, it's a strong sector. It has broken to new highs, but it's consolidating in the short term. It's going to be getting short-term oversold soon, and I think that the possibility is that if we start to see buying coming in and reversing off of this current area where we are now, then the likelihood is that we could still see another leg to the upside here.
Okay, so then mixing this all together in the top 40, I suppose it's averaged out somewhat. So the weakness of resources pulling down the strength of industrials and financials.
That's
so
it.
you know. The evidence in the rather sideways position or direction rather that we've seen over the last couple of months.
Very much so. Obviously we've got the different forces tugging in different directions, and what that has resulted in is our market, or our top 40, which represents, you know, basket of industrials, a basket of resources, a basket of financials. The whole index has really been going sideways since early June actually. But now if you have a look at the technicals here, notice that uptrend which goes back to July of last year, and notice how it's starting to come into play around about where we are now on this index. And so what this means for me, if I look at that technically, I think we've actually seen a correction in the market, albeit a sideways correction. And remember, I've said it on the show in the past, you can get a correction in time rather than a correction in price. And I think that's probably what we've seen here. The fact that this market has gone sideways for 3 months now, and now it's starting to meet that uptrend support, to me that's quite an encouraging sign. And I think the likelihood of this big pullback that everybody's waiting for, I think has become significantly diminished now. And I would more than likely expect that we see the market finding support around this current area, and probably that lays the foundation for a rally into the end of the year. And that's kind of my base case from here. And I think that this support area around 45,300, 45,500 on the top 40 is an area to be looking to buy. I think given what we've seen in the previous charts, the resources sector, the industrial sector, and the financial sector, there could be a case to be made for a broad-based rally into the end of the year from here, I think. So given that, I'm putting an option structure in place to give us downside participation if I'm wrong. But having that downside participation is going to give me insurance that we can then buy against.
Yeah, because just two factors I suppose to consider. We've seen a rally in the last 3 months of the year, for the last 4 or 5 years, and it's especially been linked to you know, the new QE programs, new stimulus programs. Those are now shifting, so those are now being scaled back, and I suppose that's the one big question mark out there for everyone. So it might scupper what is traditionally the year-end spurt.
That certainly is a possibility, and we need to be alert to that. The Fed in the US is still buying back $25 billion a month worth of Treasury securities. That is probably going to come to an end in October, but then there's talk of a European Union or EU ECB quantitative easing program, which could then take over. So let's see. Let's see what happens. I'm going to put the downside protection in place in the event that I'm completely wrong and the market goes lower, but which is something comforting to have. But the likelihood is I'm going to look for buying opportunities in the next few weeks on any more weakness that we see in the market in the near term.
Okay, well, let's get into that structure. And of course, we already have one which is unlikely to work unless there is a sort of collapse in the next, week or so.
Yeah, our current option structure for the September futures closeout, which is this week, Thursday, only works for us below 44,750 on the index. I don't think that's going to happen now. So we probably lose our premium on that, which is fine. It's not a big premium that we had, but it did always give us the ability to participate if the market had a sudden drop, which it didn't. But you know, these things don't cost us much money to implement.
Okay, in fact, this one doesn't cost you anything at all. I mean, you've managed to organize yourself a sneaky deal there, Garth. So talk us through it. Yeah,
all right. So what we've got on the chart here is a chart of, it's basically on the left-hand side, you've got the profit and loss, profit above the line, loss below the line. And then along the bottom axis here, you've got the levels on the top 40 future. Now, the first leg of this put spread option structure that I've done is I've gone long of 2 put options for December with a strike of 45,000. So what that means is that I've paid a premium. I've paid 7,600 Rand for each of these options. That equates to 760 points on the top 40 effectively. And it starts to work below 45,000. But the point is, because I've paid away all of this capital. I've bought 2 of them at 7,600 Rand each. It means I'm paying away 15,200 Rand to get that exposure. And that works below 45,000, but it works all the way to naught. And I've paid for that participation all the way down to naught. Now the market's not going to naught, let's be honest. So I can then sell away some of that downside in order to recoup some of the cost that I've paid away on these long put options. So what I've done against that is I've then gone along and I've sold 4 put options with a strike of 43,350. Those I received 3,800 Rand each. And if you multiply that by 4, it means I've received 15,200 Rand, which means that the premium that I paid on the first leg of the structure is completely offset by what I receive in premium on the second leg of the structure, which means that it's actually a zero cost structure. It costs me nothing to put this together.
Which isn't always the case, generally has cost a small premium. Was there anything different about the way you always structured it this time around, Garth?
Look, this time the strike levels are a little bit closer together, so that did affect the pricing.
Okay.
And I kind of tailored it that way that I could get it for 0 cost.
Okay, so, set this, show us how the payoff
that yellow line now incorporates the payoff of both of those options structures. So what you can see is that above 45,000, it's cost me nothing, and it starts to make money below 45,000. It makes its most profit at 43,350, and then the structure starts to give back the profit below that level. If we tidy it up a bit, what you can see is that there's our profitable zone. It's profitable between 45,000 and 41,700. Below that, we would start to lose money. But above 45,000, it costs us absolutely 0. We make 17,000 Rand, that's our maximum upside at 43,350. And that effectively gives us participation in a correction from the recent high of between 5% to minus 12% on the market. So it's quite a nice area to be protected with. If we have a look at that now and overlay that options payoff onto the top 40 graph itself, there you can see the option structure actually overlaid onto the graph itself. So below 45,000 we make our money, we make our maximum profit at 43,350, and below 41,700 we then we start to actually lose money on the structure.
Garth, there was a lot of optionality that you spoke about a couple of weeks ago around the September futures closeout. Are there any particular areas that you also want to watch out for?
Well, in the very short term, this area now around about 45,000 is actually very interesting because there's a lot of put option interest around there. And if we do see the market falling into the futures closeout, there's a possibility that we could see a bit of gamma selling into that area, which might exacerbate the selling pressure. But that's for the September closeout, which is this week, Thursday. So I'd actually view that as the buying opportunity to buy against this structure looking out to December.
Okay, so that is yet another option structure for the year. Let's hope this one pays off. But even if it doesn't,
I must be honest, I'm not expecting to make money out of that structure. What I am comforted by is that it gives me insurance that I can then buy against. And we can probably get a little bit more aggressively long given that we've got that protection in place.
Because we haven't been, admittedly, in the last couple of months, we haven't been particularly aggressive, but market conditions haven't necessarily allowed it for us.
Exactly. We've been very sort of on the fence. We haven't done a lot of trading because the market's been choppy sideways, not a huge amount of trend. And I think by and large, staying out has been the right thing to do.
And I suppose there it is reflected in the portfolio value, which is pretty unchanged, isn't it?
It's the same as last week, so we're still up 35% for the year to date. We've got these top 40 options to September, which will expire this week, and then we've opened the top 40 structure for December now, which will run out until the 3rd week of December.
Okay, Garth, so to end off with your upcoming courses, it's been a very busy couple of weeks. What have you got next?
It's a very busy month for me. I've been in Joburg and Cape Town the last 2 weeks. This coming weekend, the 20th of September, I'm down in Durban, and then the following week in Johannesburg. There's still seats available on both of these high probability trading courses, and we're running them with the 5-year promotional discount where you save 1,000 Rand. So if you'd like to attend either of these courses, please email me, garth@traderscorner.co.za, and then I'll send you the details.
Great, we'll leave it there. Garth, we'll see you next week. Thanks as always for joining us on the show. That is Garth McKenzie, founder and editor of Traders Corner.
Traders Corner is proudly brought to you by IG, the specialists in CFD trading.